Back in March, I talked about an updated model of mine of Australian short-term interest rates. And at that time, my model said that the equilibrium level of Australian short-term interest rates, the Australian cash rate, was 3.7%. Now, when I said that, people thought that was a shockingly high interest rate. But since that time, rates in Australia, the Australian cash rate has been moving up rapidly. And this week, the Reserve Bank of Australia increased the Australian cash rate by 50 basis points to 235 basis points. Now, this is something we predicted some months ago, that we would reach this level at this time. And we also predicted that rates would continue to rise. And we weren't especially clever. I wasn't especially clever in making that prediction. At least I didn't think I was, because all I did was I read the Fed minutes of each meeting as it had happened, each meeting of the Federal Reserve as it happened. And I assumed that the Governor of the Reserve Bank of Australia, Philip Lowe, was reading exactly the same minutes that I was, and would adjust the Australian cash rate in line with the Fed funds rate. So where we'd previously thought, what we previously said was that we thought that both the Australian cash rate and the Fed funds rate would get to 335 basis points in the first week of November. But what we've seen in recent weeks, we've seen Jay Powell, the chair of the Federal Reserve, speak at Jackson Hole, Wyoming, and he's talked about the need for price stability. And in this release by the Governor of the Reserve Bank, Philip Lowe, he also uses that very same phrase, price stability. And so what's happening is that we think that the RBA will continue to follow increases in the Federal Reserve. Right now, there's a debate in the Federal Reserve between about really, and it all really centres about one meeting, and that's the next meeting of the Federal Reserve on the 21st of September. Now, in that, there are two outlooks. One is, and that's it's associated with Mary Daly, who's the president of the San Francisco Fed, and that is that instead of putting up rates by 75 basis points, we should, or the Fed should only increase rates by 50 basis points. And the reason that she says the rate of increase in the Fed funds rate should be reduced is because the Fed needs to measure what the effect of its rate hikes already have been. And it needs to proceed a little bit more slowly while it's measuring the impact. On the other side, we have Loretta Mester, who's the president of the Federal Reserve Bank of Cleveland. She's associated with putting out a lot of very good research. The Cleveland Fed has put out very good research on inflation and various measures of the consumer price inflation. And she thinks that pretty much that the Fed needs to be more aggressive and continue to put up its rates by 75 basis points in September. Now, the difference is that by the end of the year, if Loretta Mester's program is followed, then rates will finish at the Fed meeting in December at 4.1%. On the other hand, if they follow the program followed by, or suggested by Mary Daly, they'll finish the Fed funds rate in the meeting in December of 385 basis points, only 25 basis points lower. Not much difference, you say. But it's significantly different in terms of just this one meeting and the one ahead. Now, so where does that leave? Whereas the Australian cash rate should be? Well, our model that earlier in the year said 3.7% now says 4.18%. That's to say 4.2%. So we think we're going to eventually follow the higher number, if and when it occurs. And so what we now believe is that the Australian cash rate will continue to increase by 50 basis points each meeting between now and the end of the year. The next one will be an increase by 50 basis points to 285 basis points. And after that, in November, an increase of 50 basis points to 325 basis points. And then a further one on top of that, or 335 basis points rather, in November, and then to 385 basis points in December. So whichever of these two factions wins in the Fed, it doesn't make any difference to us at all. Our rates still wind up at the end of the year at 395 basis points, but next year in February, rates should move up that one more rate hike to 4.1%. Now, why is it that the RBA is following the Fed to tighten rates aggressively? The reason is really that, as the governor of the Reserve Bank of Australia has said on a number of occasions, Australia now has an extremely high terms of trade. That means that we are experiencing another resources boom, which he says, says our terms of trade are now the highest they have ever been in Australian recorded history. That this commodities boom that Australia is now benefiting from is more powerful than the resources boom that happened earlier in the century. Now, back at that time, in the resources boom earlier in the century, Australian interest rates varied from a low of 3% to a high of 4.75%, 475 basis points. So we believe that what the RBA is looking at where Australian rates should be in the circumstance that we're in, which is of the major resources boom. And in that circumstance, we need to get back in this rate range between 3% and 475 basis points. But what's very interesting about that period when rates were, as we say, even significantly higher than they are now, is that back then there was not a hint nor a discussion of the possibility of an Australian recession, and no recession occurred. So we believe that the Australian cash rate will move significantly higher than it already is. We think it will do it very smartly through the balance of this year and the early part of next year. But even so, given that we have enormous stimulus to the Australian economy from the current resources boom, with prices even higher than they were earlier in the century, what we're going to get in this economy is strong growth, but no recession.